So we've got something a bit different for this deep dive. We're looking at a trading session, but through the trader's own diary.
Right. It's the warts and all version.
Yeah.
We're not just looking at the price action. We're really dissecting that psychological battle between the plan, the pre-market map, and what happens in real time.
You mean when emotions kind of grab the steering wheel?
Exactly. And the theme today is all about location, location, location.
Specifically, the danger of trading in the zones, the bid and offer, versus the space between them.
That's the whole game. We've got 3 trades to break down: a mistake, a quick correction, and then a really big recovery.
Okay, so let's start at the beginning. Opening bell rings and our trader goes long immediately. But the notes say they felt antsy, instant regret.
Yeah, this is just a classic unforced error. Look at where they bought. They jumped in right up against the offer zone.
And for anyone not glued to a chart, the offer zone is what exactly?
I mean, think of it as a brick wall. It's the area where, statistically, sellers are just waiting to push the price down. Buying there is like running straight at that wall.
And the notes here say there were no RP targets either, no range projections above that price. So there was literally nowhere for it to go.
Nowhere. There was no statistical reason to be in that trade. The map was screaming reversal risk, but, emotion screamed FOMO,
And the result was a quick stop out.
a very quick loss.
Hmm.
The market did exactly what the math said it would. It reversed.
So lesson 1, don't buy the offer.
Okay,
But they didn't tilt. They recovered. Trade 2, they go short.
this is the correction. They saw the trend change, but look at the entry. It's so much smarter. They didn't just guess. They waited for the price to break below the VWAP.
The volume-weighted average price.
Right, the average price for the day. It's like a magnet. Once the price broke below it, they shorted, and they targeted the standard deviation levels. Basically the statistical floor for that move.
I noticed something really key in the log here. They were adding to the position on the way down, but then they just stopped. They stopped adding once they hit the bid zone.
And that's discipline. Pure discipline. The bid zone is the opposite of the offer. It's the buyer's house. If you keep adding short contracts there, you're putting your profits at risk right where the reversal is most likely.
So they took their profit and flattened out.
Yep. Realized I'm in their territory now and got out. Smart.
Which sets up the final trade. It's around 9 a.m. We're in that bid zone you mentioned, and a double bottom pattern forms.
This is the A-plus setup. I mean, it's the kind of thing you wait all week for, a reversal pattern right in the buy zone.
But here's the human part again. They hesitated. The diary says they chased it. They didn't get in at the bottom. They bought on the way up, closer to the VWAP. Isn't chasing a huge mistake?
Usually, yes.
Yeah.
It absolutely is. Their risk was higher because they entered late, but the setup was so clean they took it anyway. And this is where their risk system saved them from their own anxiety.
Ah, you're talking of the VF note, the volatility factor.
Exactly. It's a metric for normal market noise.
Hmm.
Once the trade moved 1 VF in their favor, 1 unit of safe distance, they felt the anxiety just vanish.
Yeah.
The math took over. The trade was, in their mind, risk-free.
And the payoff was massive. The market just ripped higher from the bid zone all the way back up to the offer zone.
It went completely full circle. Offer to bid, and then bid right back to offer. The pre-market map nailed it.
It's just funny, The map was perfect. The variable was the person clicking the mouse.
And that's the whole takeaway. Their TradeCraft, their execution, it was messy. They got antsy, they chased. But because they respected that one core rule, sell the offer, buy the bid, they ended the day profitable.
It really challenges this idea that you have to be some kind of perfect robot to succeed.
I think it proves you don't. I mean, this trader made money despite being imperfect. It raises the question, is success about eliminating your human flaws or just having a system robust enough to survive them?
A system that works even when you don't?
That's a great thought to end on. Thanks for breaking this down with us.
Anytime.
We'll catch you on the next one.